Okay. Welcome to today's teaching, guys, and I hope you all have been doing pretty fine from the last lesson we had. Um, uh, there's a bit time space between when we had our last class and today, which is today's class here. Reason is because I'm working on some things offline. It's of my time. But regardless, I think we are ready to lecture. Today is, today should be 16th of October 2024 and 16th of November rather 2024, and next month will mark the last month of the year, and I'm trying to make sure that I cover everything that has to do with fundamentals. Let's know that we are done with that one for this year, and then next year we can go into technical. I want you guys to know that there is no difference between technical analysis and fundamentals. Let me put it this way so that you don't get confused. I want to believe that from my experience and from how far I have gone into researching about this market, when you say fundamental analysis, when you separate fundamental analysis and then you're separating it from technical analysis, it means that you're trying to bring in a one-sided opinion. Fundamental analysis and technical analysis are not different. I'm not saying they are not different. They work together. Hey, that's the word. It's like the cover of a water bottle. Okay, if the cover is not there, you can still use the water bottle. But when the cover is there, it makes the water bottle. I hope you get. So that's the way it is. You can still use technical analysis, you can still use fundamental. But when there is a way you merge both, in fact, in the MBM, in the market business model, we do not believe in fundamental analysis or technical analysis. We analyze. Okay, our analysis is just that. We don't call anything technical, we don't call anything fundamental. We just call it analysis. Because what we trade is not even technical, and you cannot even call it fundamental. What we do is that we technically represent fundamental data. So you see all these candles you're seeing here, the MBM traders believe that they are just representation of things that have happened in the back end. So when you see a candle formation, maybe like this last candle here, when you see it form, you are not seeing a candle. You're not reading a candle. You're reading something else entirely. I hope you get. Because of we do not have access to the data on liquidity, volume, and etc., volatility, and market makers, all those things. Because we do not have data on them, we do not have them raw. That is why we have to come to this technical representation of these fundamental things that happens behind the door. When we get to the transition, the place where we'll be moving from, the old fundamental, and we'll be going into technical teaching properly, I'll definitely be showing us all of these things. I'll be explaining it fully, and I'll be explaining it properly. For now, I'm just hinting you. This is just a hint. Okay. Now, I want you to know that as a trader, you will always come to a point in your trading life whereby you will feel like every single thing you know is not even enough, or they are not giving you the desired result. It will feel like upon all the stress you have put into, all the energy, all the stress, all the resources, all the investment you've put into learning, it will look as if there is no progress so far. Trust me, I have been there before and I know that feeling. But the truth is that at the end of the day, you look at yourself and you ask yourself, are you here for that immediate gratification, or you want to use this to change your life? If the answer is immediate gratification, well, I cannot convince you. But if the answer is to change your life forever, then trust me, you are not alone. A lot of people who will still go through that phase. There are people who are going through it, and people who have been there. In either scenario, you are not alone. There are still more challenges you're going to meet in the future. No matter how skilled you are as a trader, you would still be flawed. Losses will still come to you. It is part of winning. Losing is part of winning. It is how you lose that matters. And that's why in the process of teaching this market business model, when we get to a part of trading, trade management, and all those things, I'll be teaching you all this. When I say I am teaching you how to trade, I'm telling you I'm starting from scratch. I'm not telling you that, okay, I'm just going to stop somewhere. I'm going to teach you how to be a full-time profitable trader, just like me. And by the time we are done, if time permits or if opportunity permits, I might host 1 or 2 live sessions and show you how these things work. But for now, you are still learning. As long as you are still learning and you have no idea of what I'm going to be teaching you in the next coming class, then your job is to pay attention, listen, read, write, and learn. As a student, you are in no position to tell me, oh, this is what I want to learn next. This is what I think I am feeling. This is what you don't know your issues. I'm your teacher. I'm the one that can tell you, okay, this is where your problem is coming from. Focus here. I know it can be frustrating sometimes. You see your mates making money. You see people on Twitter, Facebook, posting big payouts, and it looks as if you're not even making progress. The truth is that 99, if not more than that, 99% of those things are fake. Don't let them put you in a state of depression. Ask yourself this simple question. It is true that everybody on social media, every profitable trader, if it is true that everybody on social media is profitable, you yourself, have you come across one single profitable trader who have shown it to you and proved it to you? If the answer to your question is no, then you should stop believing all those things. I'm this kind of person that I do not believe something until it is done in my presence. Until you show it to me live and direct, you clear my doubt. You don't just come here with screenshots of running trades and all those things. I can do it. Everybody can do it. Just place a buy on one account, sell on one account, post it. Anybody can do it. Do other things. Change servers. We can do it. There's nothing special. But until someone do it in your presence, live and direct, then your belief in that thing should be limited. Okay? But anyways, that's not the topic for today. We'll have a lot of things to discuss as we go forward in our teaching. In today's class, in our classes, I've been speaking and I've been teaching. Recently, in our recent classes, I've been teaching about volume, liquidity, and we're about liquidity, volume, and we're about to move to volatility. In our last class, I was unable to finish talking about volume, and I promised that we're going to continue in our coming classes. But I had to rewatch those videos, and I realized that I'm not fully comfortable with the way I've been using, buyers and sellers, buying and selling. Okay, because in this market, you don't buy and you don't sell. Unfortunately, that's it. When you place an order on your broker, you don't buy. You are not buying. You don't have the power to buy or sell in this market. You are not the one that buys or sells. Please listen to me. I don't care if it goes against what you've been learning. But this is my class, and I am teaching. I am the teacher here, so please pay attention. In this forex market, this currency market, you as a retailer or smart money or whatever you call yourself, you do not have the power to buy or sell. You don't. So I have not been comfortable with, the idea of hold on. Okay, so I've not been comfortable with the idea of using the word buyers and sellers because it's not accurate. It's not accurate. It's wrong. Or let me say, in the market business model, we don't use it. Okay, and the reason for that, I'll definitely explain as we proceed in our classes. But the reason why I have to teach you thoroughly of how this market operates is because of so that you don't get confused in the future. So that whenever you take a trade, you take it from a standpoint of confidence. You are not confused. You know what is happening. You know why that candle went up before it came down. You know where it will go to before it goes up. You know how things happen. You are familiar with it. You might not be in every move. You see the whole fall here. You might not be able to sell to be in all the whole move. But when it comes to explaining them, you know them everything. You know what happens and what is not happening. From here, you know what will happen next. That's why I'm teaching you all these things. That's why I'm taking my time to educate you. Your job is to listen. So in this market, you don't buy, you don't sell. You as the retailer, you don't have the power to. What you do is bid and ask, and that is what I'm going to be talking about. Because like I said, I'm not comfortable with the way I was using buyers and sellers in those videos, because that's not the word I was supposed to be using. So I'm going to continue on full explanation of volume, but this is a what's it called now? This is like a class that is needed for us to proceed forward, because from here on you stop seeing me using bidding and buying and selling. I will stop using buying and selling. As a trader, you don't buy and you don't sell. Okay, now let's go into teachings properly. You see, in this market, there are two participants. Someone who's willing to take and someone who's willing to give. Now, for every giver, there must be a taker, and for every taker, there must be a giver. Remember, this market operates on transactions, as I've taught you guys. Okay? This market operates on transactions. Every single thing that makes for all these candles you are seeing here is a singular transaction. And that every single transaction must have an opposite. Every single transaction must be a one-way thing. Or is it a one-way or a two-way now? I don't know. That what I'm just trying to say is that for every buyers, let's imagine this is for every buyers, for every buy, let me use for every buy. There must be a sell. Okay? For every buy, there must be a sell. And for every sell, there must be a buy. What I'm trying to say is that before you see AUD start going up, it is not just because of they are buying. No. It's because there were people willing to sell and people are buying into those orders. I've shown you there were more buying than more selling. Okay? Now, this is true. Okay? But the question now is that if you think it is only, how do I put it now? If we use the word buying, it does not cover the essence of the activity that is being done in the market. And if we use the word selling, it does not cover the essence of the activity that is being done in the market. Because as much as you can say, oh, a buyer, somebody is buying, let's say this box here, let's say this is what they are transacting. This box here is let's imagine it is gold, okay, gold bar. So the buyer wants to buy gold, the seller wants to sell gold. So the buyer comes with what? Money, Abi? Good. Yes. So the buyer comes with let's imagine buyer comes with money. Okay. So remember, for every transaction there must be the resources of exchange, as I've taught you before. So the buyer wants to buy gold with money. The seller is willing to sell gold for money. So the buyer gives the seller what? Gives the seller money, and the seller gives the buyer the gold. Now, this is what happens. Let's return them back to their prospective owners, their owners. Now, this is what happened. We call this person a buyer. Why? Because from this side, this is the side that we are looking from. This is from the side we are looking for. We're looking from the buyer perspective. And from the buyer, the other person will always be a seller. Which means the buyer wants to buy gold and is giving out money. But do you know that the buyer can still be a seller? If we look from the perspective of the seller is actually buying money for gold. So the seller is also a buyer. Why? Because what he is doing now is that he is buying money with gold. Buyer is selling money for gold. I hope you see how this thing is intertwined. A buyer, it just depends on the side you are looking from. And this is where the market now, becomes complicated for people, and they don't understand what's happening. And this is where they will not start telling you, oh, there is much buyers than seller, which is wrong. There can never be more buyers than more sellers. The market is always balanced. There is nothing like imbalance. There's nothing like imbalance. Without a buy, let's imagine now somebody wants to buy gold and then the seller is not there to sell. The buyer only has his money. He craves for gold, but is there somebody to sell gold to him? Oh, so will he just say, okay, I want to put my money there? No, that's wrong. There must be somebody first who's willing to sell gold to the buyer. The same thing for the buyer. The buyer cannot just, so the same thing for the seller rather. The seller cannot just say, oh, I want to sell my gold. What do you want to sell your gold for? Nothing. So will there be a transaction? No. Until there is what? A buyer who's willing to buy that gold from you. From the seller rather. The same thing can happen. But then if we now look at it from a more logistic perspective, we see that a seller is actually a buyer. Why? Because he is buying money with his gold. And the buyer is also a seller because he's selling his money for gold. And this is where market now becomes confusing for many people. They keep on telling you, oh, there are more buyers than sellers. It's not possible because you can't sell without buying and you can't buy without selling. Okay? But there are situations where there can be more buy orders than more sell orders. And this is where we don't call them buy orders and sell orders because it's wrong. That's not what it is. In fact, that's not what it's doing. When you say you buy something, it means you have completed that transaction. It is in volume. It is wrong. Instead of buying, it's called bidding. And instead of selling, it is called asking. In fact, asking and bidding. Hold up. Bid and ask. Let me delete this. One minute. Bid and ask. That is what we do in this market. Every trader, I just use that buying and selling to help you understand this bidding and asking. Okay, it's just to help you have a proper refresh your memory a bit. Now, if it is true that for every buying there must be a selling, but in what situation is it that there must be because it happens, there will be points where there will be more buying and pressure than selling pressure, but that is not the way you've been taught. So please listen. In this market, there are two things that can be done. In this market, we do not see how do I put it now? We do not see it as there's a word I want to use. Guys. Pardon me. Let me try to remember the word. Yeah. In this market, we are not seen as a body. We do not perceive ourselves as a body. We perceive ourselves as per what we do. It is what people do that makes us give them their name. We don't just call them the name just because of what we feel, but based on what they do. Okay? If you call people or someone, or if you call something buyers, you have limited them to that thing, buying. They are just buying. But a buyer can actually become a seller. I hope you know that. And if you call people sellers, you have limited them to selling, because a seller can also become a buyer. In fact, someone who is selling might not even be selling for selling's sake. He might actually be selling to buy. There are a lot of things in this market you don't know. I don't know. But this is where proper knowledge comes into play. So there are only two things every single body in this market: smart money, dumb money, retailers, banks, JP Morgans, World Bank, whatever you call them, IMF, whatever, central banks. Okay, so sorry for that little break. Now, I'm not going to spend much time on bidding and asking, bid and ask, because of I do not want to cover a lot about it. It's very broad. It's very, very broad. So I will just focus on the ones that are important for these lectures. Probably in the future I might talk about them. Now, the bidding price, please pay attention. The bidding price is the highest price, okay, someone who is buying, okay, will pay for the currency. And asking price is the lowest price someone who is selling will accept. So this is a negotiation between a buyer and a seller. That's what bidding and asking means. Bidding and asking, see them as negotiation. Bidding means the highest price a buyer would pay. Asking is the lowest price a seller will accept. So it's like when you go to your local market and there is a negotiation between you and somebody who is selling, let's say, frozen food, for example. The frozen food owner will tell you he's selling at 1,000. But you that want to buy, what will you do? You try to beat the price down, right? Exactly. You try to beat the price down. And so to you, that is the highest you can pay. If that 1,000 is okay for you, no problem. That is the highest you can pay. So the highest you can pay is, let's say you now beat the price down to 900 $900. That is the highest you can pay. What will happen to the woman who is selling frozen food? She might tell you that I can't go below 950, and that is the lowest she can accept. So bidding and asking is like negotiation between the buyers and the sellers. When you bid, you are offering and you are saying, CEO, this is the amount I'm willing to pay. And when you are asking, you are saying, CEO, this is the lowest amount I'm willing to accept. Anything below that price, I don't want to collect. If you are bidding, you are saying anything above that price, I'm not willing to go higher than that. I hope you get now. So when you see bidding or bid price, what it is just telling you is that that price is the highest price. Okay, somebody is willing to pay at that particular period for that asset, for that currency. And then when they tell you, oh, asking price, it's very simple. What I tell you is that is the price, or that is the offer someone is willing to accept. It's like you're giving somebody an offer. Oh, I am offering you a deal. On this deal, this and this and this and this is what will be on the deal. And then the person will not say, okay, it's okay for me, or it's not okay for me. I hope you get now. That it's as simple as that. Now, there are more explanations to this, but this is the simple explanation. Bidding and asking is like negotiation between the buying side and the selling side. So if you are selling, you as the trader now, if you are selling, bid is the amount you pay. So you have a currency now and you want to sell it. Okay, and you want to sell it. Someone will have to bid your currency. They will have to bid it. So let's say if Euro USD has a bid price of 1.1, a buyer will be willing to purchase at that rate, because that's that's the highest price that person is willing to pay. I hope you get. So let's say you want to sell now. You want to sell. What you will collect is bid. You bid price. And if you want to buy, what you will collect is ask price. So you see, how do you now know this bidding and asking price? How do you know them? It's very simple. On your broker, when you go to MT5, you see them. You see those price quotations, those two lines on your brokers. Okay, there's two lines. That is why whenever you place a buy order, you see that your buy order does not get activated at that point where you place that order. So let's imagine price is here and you place a buy order now. Your price might go and your order might go get filled at a higher price. Or you place a sell order, you want to sell, your orders might go get when you place a buy orders, your orders might get filled at a lower price, and when you place a sell orders, your order might get filled at a higher price. And that is what causes spread. You see the difference between the amount, okay, that someone is willing to buy and someone is willing to sell is what we call spread. And that's how spread is generated. And this spread is how the market makers make their money. I hope you understand. Let me take that again. Bidding price is the highest price a buyer is willing to pay. So if you are the one that is buying, you are a bidder. If somebody else is buying, he is bidding. I hope you get now. So you are not just bidding, is not just limited to buyer side only. Okay, if somebody is willing to pay, it is highest price. Okay, this is the amount they are willing to buy that asset. Okay, so somebody come and meet you and say, okay, I'm willing to pay 20 naira for your plantain chips, that person is already bidding, and that is the highest price he's willing to pay. That ask price is now you saying, and then you now say, my plantain chips is worth more than 20 naira. You have to pay 25 naira. What have you done? You have asked. The person bidded at his highest price he can pay. You now asked at the lowest price you can collect. The lowest me I can collect on this thing is 25k. I cannot collect more than that. You see, we have just transacted on the bid on one side. The same thing on the ask side. On the ask side, you want to buy something from someone. The person tell you is 20 naira. That's the lowest you can collect. And then you are saying the highest you can pay is 19 naira. You have bidded while the person have asked. So either bidding or asking, it is still the same thing. It's just that, you see, it is still the same thing. There is no difference. If we look at it from the perspective of explanation, someone who is bidding must meet someone who is asking. And someone who is asking must have, like, there must be a bidding offer to match an asking offer, and asking offer that, you know, is willing to. It is not even matching, it is willingness to accept. If you are bidding at $1 and nobody is willing to accept at that $1, your bidding offer will still be there. Your offer will still be there. And if you are asking at $10 and nobody is willing to bid, to accept that offer, rather, not bid, to accept that offer, then you keep on waiting. For every bid offer, there must be an acceptance. For every ask offer, there must be an acceptance of that offer. I hope you get what I'm saying. So when you bid at $10, there must be an acceptance for it to now be activated and considered a buy order. What you have just done is just bidded. There's no buy order yet. And for every ask order, there must be an acceptance. So let's say you are willing, someone is willing, you are bidding for $20, and the person is who, the person is telling you to pay, let's say, higher than that, and you are not willing to pay. What happened? You remove your money. It's not okay for you. You remove your money. You say, okay, you go to another place, or that's the end of the deal. That's what bidding and asking does. So it's a negotiation. Now, if you bid at $1, you are bidding for at let's say $1, and the asking price is at $2. 2 minus 1, right? You see that $1, that is what we call spread. And that spread is how the market makers and your brokers make money. We'll go deeper into that when we are talking about market makers. Now, a bid order can be in form of a limit order or market order. A limit order now means that you have placed orders at places where price is not there yet. While a market order means that you want to place an order now. Now, this is what happens. If you are willing to place orders, and now anywhere you place your order, anywhere you bid, anywhere you bid, any price at which you bid, because of you are a retailer, you do not quote this price for yourself. You must be willing to accept whatever offer the market maker are giving you. This is what I'm saying. Now, because of spread is how market makers make money. Now, normally, this is how it should work. If you are willing to pay $2 and you go and meet somebody, and that's the amount you are offering. That's the amount you are offering to pay. That's the amount you are offering. Okay? You are asking, rather. That's the amount you are asking. You have to meet somebody who is willing to, what's it called now? You want to buy something, okay? And the amount of that thing you are willing to buy is $2. That's the amount you are offering, yeah? That's the amount you are bidding. You must go and meet somebody who is willing to accept that $2. And then both of you complete transaction. But you see, in this market, that is not how it works. buyers and sellers don't connect. Bidders and askers, they don't connect. There is an intermediary between them, and that's why I put this line here. There's an intermediary between them, and that intermediary is called the market maker. Now, the market maker can be your broker, it can be the market makers, it can be whoever is offering you that service. But the market maker is like the middleman. They are like the middleman or the middlemen. The market makers are like the middlemen. They take your orders here and then they pay it to this one. It's like saying you want to buy iPhone 16. That's what you need. But you cannot directly go to the factory to get iPhone 16, right? Because you don't have the power to do so. In fact, for you to do that, it will cost you more. It will cost you a lot for you to travel from Nigeria to the factory. Then you stress, you do this, you do that. At the end of the day, you have even spent unnecessary money. So there are people who sells iPhone. What they have done is that they have bought this iPhone in massive quantity. They have them in stock. So whenever you want to get an iPhone, what you will do is you will not say, okay, I want to buy an iPhone, but the amount I'm willing to pay is $2. And then you send out orders and the market maker will see it. Then they will now look at the asking side. They will say, is there anybody willing to sell iPhone at that $2? If there is, then they will match your orders. So they collect your money, they give you iPhone. Now, if the person who owns the iPhone is willing to sell at 1.98, right? And you are willing to buy at, and you are looking for $2. You're willing to buy at $2. What the market maker will do to you is that they will tell you to pay $2.2 instead. And this person who is asking, they will tell him to pay 19.8. So they are taking money from this side and they are taking money from this side. 2 cents each. That's 4 cents. Now, the difference between the amount you pay and the amount this person pay, that is now the spread. And that spread is the amount that the market makers used to pay themselves for the whole stress of completing these orders. I hope you get. So the person who is selling iPhone will tell you, okay, my iPhone, the iPhone cost $10. Yeah. Let's say you are willing to pay $10 rather. And then they will just tell you, okay, pay 10 points. Just pay $12. And then you pay the $12. They'll give you the iPhone. That way, they don't need to wait for somebody on the other side. Remember, they have the iPhone already. They have bought it from the store. They have it with them already. So when you say, okay, I'm willing to pay for an iPhone at the rate of $10, they will tell you to pay $12. Why? Because they have it in store. You don't need to wait for somebody who is willing to sell again. Normally, you need to wait for someone who is willing to sell, but that will take time. So the market maker have the iPhones plenty. So once you want to buy, they fill, you buy, they fill, you buy, they fill. And then the amount they are adding on top of it, which is what? The amount they are adding on top of your offer, which is the ask price, yeah, which is the amount that you will pay. Yeah, the amount you will pay is the ask price to them. The amount you will pay, yeah, which is the amount that they are asking you to pay. You might be bidding at $1 and they are not willing to accept that $1. They will now ask you to pay $2 instead, and then you pay. And then they fulfill your order, they give you the iPhone. The same thing from askers. Askers is looking for someone who is willing to sell, who is willing to sell an iPhone. Remember, a bidder is looking for someone who wants to buy. Asker might be looking for someone who's willing to sell. And these people have it. So what they do, they just fill these ask orders without needing the askers to wait for the bidders. So what they do is they buy it in stock. iPhone plenty. They have so many iPhones in their warehouse. And the amount, so it's like they are the middlemen and they charge. So your bid price and the ask price is the amount that they charge, the market makers charge for helping you fulfill this order. That's why you can wake up anytime in the market, place an order, it will be activated. Without the market makers, let's remove them from the picture, you will need to wait for somebody who's willing to, and that might take time. That might take a lot of time. But the market makers coming into the picture, it's just like saying, it's just like the market maker is like a store, a phone store. You just walk into there, make an order, pay your money, and you go. You don't need to now wait for somebody who's willing to sell that kind of phone, and you might never see. So when you go to a phone store, are you the one that will tell them the price you want to buy their thing? No, they're the one that will tell you, okay, this is the amount we are selling this one, this is the amount we are selling this one, and then you will now have to pay. You will have to pay. If you want to sell a phone to them, they will tell you, okay, this is the amount you want to buy the phone, this is the amount you want to buy the phone, and then you have to accept their offer. And this is how spread is created. So that price that you bid, that price that whenever you place let's say you place a buy order now, you place a bidding order, a buy order, you will notice that market will not fill you at that same order. Okay? It will fill you at a higher price. Let's imagine this is the price, and then you place buy. It might fill you at a higher price. It might fill you at what's it called now? At a lower price rather. Is it at a lower price now? Yes. At a higher price. So I want to buy at $1. You just see that you get filled at $2. Price have not gone there. Price is still lower than. So price is here. Price is here, but they have filled you up there. They fill you up here. So from here to here, once you do the minus, the amount is the spread. If you want to sell and price is currently here, you see they'll fill you up here. Okay. I'm coming. Yeah, if you want to, let's say you want to sell now, and you say, okay, price is currently at $1, and I'm hoping that it goes to $0. Okay, they will have to fill you up at a higher price. Why? Because price must, that's their spread. And then if you want to buy, you're looking at, okay, price will go higher, and price is at $1. Yeah, and you're willing to purchase an order. They'll have to fill you up at a, what's it called now, at the price that is okay for them. So either you are buying, if you are buying from them, you have to pay the spread. Okay, you have to pay the spread, which is higher. And then if you are buying, you have to pay for the their bidding price, which is definitely big. So yeah. So that's how spread and ask works. Now, how does this affect you as a trader in the market? Liquidity that I've been explaining, volume, and this is what will bring us back to liquidity and volume. I'll still explain properly on market makers and what they do. But for now, I hope this helps you understand how bidding and asking, as how they work, and how the market makers come in to help you complete these orders. Now, whenever you place orders as limit orders, whenever you place, or not only you, there are thousands of people placing orders. It's either they are bidding or they're asking. And these orders will come in form of what? Limit orders. Begin to see orders. You might not see them, but on the bid side, and this is where we can now separate the market into two sides. And then we can now start studying order flow. We can call this part the bidding. We call this part the the bid side, and then we'll call this side ask side. Call this the ask side. Whenever there are bidding offers coming in, it will be recorded on this side. Whenever they are asking us the orders coming in, it will be recorded on this side. Now let's imagine there are 10,000 bidding orders that came in at, now remember it must be at a price. So let's imagine this price here is, this yellow line here is $30. That is the price. So there are 50,000 bidding offers, and there are 50,000 and there are 10,000 asking offers. What do you think will happen? The market maker will have to buy everything, yeah, but it doesn't mean that this thing have been filled. So what they have just done is that they have bought. They need to sell. They need to sell because they can't just buy. What if they are sellers? You get? And in fact, I think I should explain this in our next class. Yes. Let me just stop here. Go and ruminate on what I've taught you. This thing I've explained to you here. Market maker, bid and ask. And then we'll talk about it. But let me just continue. Since I'll just make sure I wrap it up. Make it make sense. Now, when 50,000 orders come in form of bid offers, remember the market maker are in between. They will have to buy these orders. Now, sometimes they might not be able to buy all these orders. Sometimes they might be able to buy. We don't know. Those ones are not our business. We don't know. Do you know what our business is? Our business is very simple. When these orders come in form of liquidity, where are they coming into? At what price? And that's what we care about. When they come, we might not know them because the point is that they are coming as limit orders, market orders, or stop orders. We don't know how they are coming. But at least we know that if price is not here yet, then it is definitely limit orders and it is liquidity. What I'm trying to say is that if, let's imagine this is price, where price is currently at. Anything above and anything below price is liquidity. Anything above and below price is just liquidity. So when you place an order here, what have you done? You have brought liquidity into the market. Either you bid or you ask, you have brought liquidity into the market. I hope you get what I'm saying. Now, you know you can cancel this order, right? Good. So by the time you now cancel that order that you brought into the market, what have you done? You have pulled out liquidity. And this happens every day. So people place liquidity, remove liquidity, adjust liquidity. That's why liquidity is not something that is stagnant. It moves, it shifts. It shifts. And price will now try to go to areas of this liquidity. Why? In form of volume. Volume means bidders and askers have accepted their offers and now their trade is active. You cannot tell me that, oh, if I ask you how many phones did you sell today? If there are 20,000 people who offers to buy the phone and none of them bought, you don't have volume. Until they bought, that is when you have volume. So volume is only when orders are matched around price. Volume is price. Volume is what moves price. Liquidity is what draws price. So you see liquidity everywhere, above and below. So market makers need all these orders to be filled. They need all these orders to be filled. They have it. If they buy, they need to sell. Why? Because those who are bidding, the market maker are the ones selling to them. It is not the askers. So the price, so the thing is not balanced. The market makers need to balance it. And why do they need to balance it? Not because of the market inefficiency or whatever. They need to balance it because of this is their money. This is their money. They need to make profit. They might not be in loss, but they are running out of inventories. Tomorrow we'll talk a lot about them. These market makers, they are the one that makes the market we live in, and we need to understand them. By the time you understand them, you understand a lot of things. Okay, so in our next class, I'll be talking about market makers, how they relate with bid and ask. I'll speak about it extensively. Today, I just wanted to teach you what bid and ask and how market maker play with them. So tomorrow, next class, I'll be talking about market makers and liquidity, how they relate with liquidity. Because you cannot understand market maker, how they relate with bid and ask, and then you don't know how they relate with liquidity. If you understand this thing, then you will not be confused why sometimes you just see one very long spike in price. Just see one long candle like that just move. Don't worry, all these things you will understand them. They might look like, oh, this guy is speaking too much grammar and everything. Don't worry, it's very easy to understand. Sometimes you don't understand something until you get to a certain point and you're like, oh, okay. Maybe when we get to volatility, you understand it. Okay. Very soon we'll start going into the charts. Yeah, we'll definitely start going into the charts very soon. I think we have like 3 or 4 more videos. After our next class, I'll talk about volatility, and then I'll talk about how everything works together to make sense, so that everything will make sense. How volume, liquidity, market maker, ask and bid price, how all of them, how they form an order flow. How they form an order flow. I'll show you, I'll show it to us. I'll teach you the order flow principles. Okay, how they form an order flow. By the time we are done with that, I think that's about, order flow is not something you can finish in just one class. So I'll teach you everything in about maybe two classes, and then once we are done with that, we'll now move into how all these things that I've taught you can be represented graphically, illustrated graphically. I will not use candlestick. We will create our own form of identification. Candlestick is just because of we do not have our own. MBM traders, we don't use candlestick. I'm telling you now, we don't use it. There's something else we use, and those are the things I'm going to be talking about and teaching. Okay, but till we meet in our next class, you have a wonderful night rest. If you have any questions or anything, I usually host spaces on X, Twitter. So follow me on Twitter. Wait for whenever I host my space, and just request for the mic, and I'll answer all your questions. You have a wonderful